color out there. We have our market master of the day now ready to speak with us. Kenneth Andrade is founder and CEO at Old Bridge Capital Management. Kenneth, it's always a pleasure. Great to have you with us here. Prashant this side. You know, Kenneth, you are one of the only people who's not positive on banks. I don't know if you've changed your mind after the steep correction, but you've not owned banks for a long time. And the last time we spoke here on the channel, you said it's unlikely that banks will have a super run ahead. It's played out spectacularly so far. Just explain. I just want to start there. Do you maintain that view, and just explain to us the reason behind your conviction there?
So if I just step back a bit, I think what's happened over the last couple of weeks or probably a month or so is that the trend in inflation has actually moved up quite significantly. And if you have to put it in context, the decade going forward, I think this word will be talked about quite a bit. So everything that's happening on the ground is going to be inflation-linked, and that's not going to do very well for financial assets. Yes, there is a small space in financials or lending, in the lending business, wherein companies that actually fund assets on the ground or fund capex on the ground have a play in it all. But that's going to take some time coming. It's not going to be as good as tomorrow. So what you see right now, and every time you see credit growth happening, just strip away inflation from that credit growth, and you'll get a sense of how things stand on the ground. So yes, I'm a little apprehensive of that space still. I think we've gone into a cycle wherein retail credit is not that great. A lot of institutions still have to clean up the balance sheets as far as NPAs are concerned. And this time around, it is not on the corporate side. It happens to be on the retail side. So I'd wait on that stance. Historically, we've had an apprehension about valuations. We've worried about the fact that the entire street and the marketplace was trying to fund the bottom end of the pyramid. Their solvency was an issue, and it's all played out in terms of higher credit costs. See, credit costs are the biggest cost for the bank. As long as that remains and is going to remain sticky, this is not a segment of the market that we will look very favorably upon.
Okay. Kenneth, good morning. We've seen a sharp correction in the broader market after the last year's rally. Do you think, given the current environment and rising interest rate environment, perhaps there could be more on this side, or do you think there's enough correction now to perhaps start rebuilding a portfolio?
I wouldn't expect too much from this calendar year, though I'm still fairly optimistic that this year will not be so bad for India, and I come specifically by India and some of the emerging markets than the rest of the world. But I wouldn't expect anything compared to where it was last year. You will get volatility this year. You will slip into negative territory, but overall, portfolio should be pretty okay. Now, why do I hold on to that point of view? Look, the marketplace is moving to a cycle, or the economy is worldwide moving to a cycle where you will see capex at a scale that you haven't seen before. I mean, every global economy, or small or large, is going to rebuild their infrastructure assets and their manufacturing assets, and all of this is fairly material intensive. Now, as long as this emerging markets continue to have a dominance on low-cost manufacturing or low-cost solutions, providing low-cost solutions, I think we got a fair chance of growing faster than the rest of the world. So maybe we got an outside chance, and it will show up this year compared to everything else versus the rest of the world. That companies in India will continue to grow. This year it will be because of inflation and because of price movements, and may not be volumes. But next year, I think volumes also should be fairly robust. So no, I'm not very negative on this year. We might go through a little bit of volatility in the short term, which is what we're seeing. But I think things should, once the international scenario stabilizes, we should be back on track.
Kenneth, hi, good morning. I was going through one of your older notes and looking through your sectoral bets. some of the spaces you like are engineering and ancillary businesses, also automotive ancillary businesses, which have done very well, but now there are new issues cropping up in terms of semiconductor shortages globally, a demand crunch because of what's happening in Russia and Ukraine, etc. Would that be a cause of concern for you, or is that just something that investors need to perhaps wade through and keep the faith in these names?
So in the short term, you've got to digest all the negativism. Okay, the whenever there is supply side shortages and whenever there is inflation, remember entrepreneurs across the world are looking for higher profitability. You will have capital attracted to this sector. So you will just have to overcome this hurdle. Maybe it will take about 6 months, maybe 1 year, maybe 18 months, but you will overcome this hurdle. And look where we are positioned. We probably end up in a year or two as one of the cheapest producers of steel in the world. Okay, and that's the reason is because we are almost fully integrated. Most of our companies are fully integrated. Now, with this kind of an advantage, any business that is linked to having this commodity as a base product or as a raw material input will have a significant advantage globally. Okay, look at what happened to tech. We basically sold a low cost of manpower and created an industry which is that large. If we can put together the basic building blocks of any industry or any business. I think the entire value chain could be quite competitive globally. We've seen that in pharmaceuticals and chemistry. We've seen that in chemicals. We probably look at the entire value chain, which feeds off steel. So medium term to longer term, I don't see an issue with this industry scaling and becoming reasonably large. Short term, we'll just have to digest the negativism and just look at and just wait for things to improve. But that, I guess, also gives you great prices to buy into.
Kenneth, two questions. One, you own IEX, you've owned it for a long time. Have you looked at another exchange, but the commodity side, MCX, which has fallen off a cliff? It still trades at 40 times earnings, but it's come off sharply. Any thoughts there? And second, you own a bunch of agri names, right? I mean, there is Kaveri, Chambal, and a bunch of others. Have you looked at the impact of what's happening on the supply shortages on that part of the market?
Yeah. So when it comes to power and the ancillary businesses, I think we're still fairly positive on electricity consumption. If manufacturing needs electricity, your correlation with manufacturing used to be 1.1. It could be 1 this time to GDP. I think that will sustain itself. So we're going into a relatively higher growth trajectory than what we've seen in the past. That should sustain. The commodity index, you've got significant amount of commodities. You've got a commodity super cycle in progress, and I can't see why any institution that doesn't deal with commodities not do well. So I think that subject to regulation, because there's some regulatory interface that is required for that particular exchange to become global. But once that is in place, I think that should be all that. That business also should be relatively easy to predict. Okay, so if you ask me, I'd have a positive bias towards that. Now, agriculture is going to be like every other commodity. It's going to be inflationary because global trade is coming down, and as countries continue to push yields or higher productivity, you will need a whole host of inputs that go into the ground. Right, and that's where we think this part of the world would do extremely well, not just in India but everywhere in the world. Okay, so agriculture inputs, it's not a business that's been invested in for an extremely long period of time. Maybe the cycle has taken some time to mature. My sense is it will be a decade that will belong to this.
Okay, Kenneth, we'll leave it there today. Thanks a lot for joining us and have a good day. That's Kenneth Andrade. Let's move on then. Mark Mobius